Okay, good morning and welcome back everyone to our Friday rapid fire analysis session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And we have had a lot of requests here today, mostly across the spectrum of technology shares. I think this is a factor of the market conditions that we're currently in, the tech shares that have sold off very heavily. Many investors are probably wondering whether they are symbols that they should probably continue to hold on to or perhaps get back into. Also, we have just a wide variety of technology shares that were predominantly requested here for today, over 400 different symbols requested. So we're going to take a look at the top symbols and go over them here today. But before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation and recommendation to buy or sell any specific securities. Now, just a little bit of housekeeping before we get started here for today. Next Wednesday, March 17th at 4:15 p.m., me and Tom Sosnoff, we're going to be talking a little bit of a different topic than we normally do. We're going to be doing an introduction to futures trading, specifically the small futures. Now, I wanted to bring this to everyone's attention because it's I actually started my derivatives trading in futures. I learned how to trade with Tom. So I think this is a great introduction for those of you that may be interested in futures trading, but have maybe found that the contract sizes were too large for you, or that they were confusing in terms of the fact that they are slightly different contract sizes for different types of asset classes. And the small exchange recently launching brand new futures exchanges specifically for retail customers, where they're all fairly small. Most of the margin requirements are just a few $100s per contract. And it gives you exposure to equities, interest rates, precious metals, the US dollar, all of these that are not always easy to trade when you're trying to trade ETFs that list some of these indices. So the futures market gives you direct exposure to those asset classes in a more capital efficient way, and there are no pattern day trading rules. So if you have an account under $25,000, you can trade futures all day long without having to deal with the pattern day trading rule that you have in equities. So I'm really looking forward to that session here on next Wednesday. I hope some of you who are interested in futures trading will join us here for that session. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And during today's rapid fire session, the goal of this session is to show you how I think through an idea, right? You guys posted over 400 different ideas to us over the last 24 hours. I've taken those symbols, and I simply took the ones that are most requested. And what I'm going to show you is how I view the technical chart to gain a directional view from the technicals perspective, and at the same time look at the fundamentals, whether I'm looking at how the business operates, where they operate within the space of their competitors, and also more importantly, just their revenue and profitability. Those are important metrics to understand, especially in the current market conditions that we're in. A lot of investors are asking, do we expect markets to resume its bullish trend? And certainly there are many factors that suggest that we can continue moving higher here in equities. And if that is the case, how do we determine which symbols do we leverage our capital in during this type of potential rally in the markets, or if we expect more of a pullback here, as interest rates continue to rise here today, where do we expect that pullback in those high beta tech stocks? How do we look at the spectrum of technology stocks? So I'm really glad that so many technology stocks were requested during today's session, and we're going to take a look at them together and show you how we think about these types of opportunities. And many of you follow me on CNBC every Friday at 5:30 p.m. on Options Action. The process that I'm going to show you that I go through with these symbols is exactly the process that I use to determine whether a symbol that we're going to talk about on CNBC, what my views are, whether I'm bullish or bearish, and how I leverage an option strategy on the back of that. So I hope many of you are able to join me this afternoon at 5:30 p.m. to see perhaps one of these symbols on TV later here tonight. So let's take a look at interest rates first, because that's really what's driven the market conditions here over the past few weeks. We've had a substantial rise in rates from an absolute basis. Relative basis, it's still pretty low compared to 10-year over the past 10 or 20 years of yields, 159 basis points is still on the lower end of the scale. But we've recently breached this 38.2 fib level, which is from the decline from about 330 basis points down to about 50 basis points. We've retracted, we've retraced 38% of it. We're expecting perhaps a retracement up to 50%, which would put us in the 185, 190 basis point range. Right now we're at about 160 basis points or so. So we have a bit of a small double top here that's formed, and we're looking for a potential breakout here to the upside, especially as another $1.9 trillion in stimulus is being passed. This is what's driving this inflation expectation. That's why we're seeing this sharp rise in yields. And this has put a big contraction on the high beta tech stocks, but not all high beta tech stocks, not all tech stocks need to be grouped in the same category, which is why, again, I'm glad that there were a fairly wide range of tech stocks that were submitted as symbols, because it really provides us with a way to view the full spectrum and understand where we see opportunities and where we think there's further downside. Now, if we look at the S&P 500 yesterday, failing at that intraday high, trying to make a new high, but by the close, we failed to make a new high. We're seeing this across the board on quite a few of the indices. But the fact that we failed to break a new high is certainly at first, potentially a double top and another pullback here is what could happen. And so far right now, as of the futures this morning, that looks like where we're headed in terms of this is a bit of a double top here. We really need to see a breakout above this level for bullish markets to continue. Until that happens, we're still in this neutral state here for the broader markets. Now, the Qs managed to just break out above its 21-day moving average here yesterday, which if it can manage to close above that level here today, would certainly be more bullish back towards this all-time high. But so far, looking like futures this morning, it's back below that 21-day moving average. So in my opinion, this could potentially revisit that $300 level, 298 level, especially as yields continue to rise. This is the segment of the market or sector of the market. If you think about the NASDAQ 100 index is really more of a technology sector index, this is the sector of the market that's going to continue to get hit. So that's where we currently sit on the two major indices. The NASDAQ, the Russell 2000, the small cap index, did manage to close above all-time highs here yesterday. So this is one that we can continue to see more strength here, especially as the SPY and QQQ remain more range-bound. We could start to see small caps continue to rally, because it's really the stimulus-driven recovery trade that has driven the strength here that we've seen here in small caps. So that's where we currently sit in the broad-based indices. And just to give you a sense for, these were the symbols that were submitted for today's session. As you can see, a pretty wide gamut of different stocks, but the big tech names up top, some questions regarding NEO, ARC. This is the big technology ETF that a lot of investors are trading these days. You have DraftKings, you have CCIV, you have Plug Power. You really have a pretty apps, you have ChargePoint, you have DocuSign. So you have a pretty wide range of different technology shares that we're going to go through here for today. So let's go ahead and get started and take a look at these stocks. So we'll start off with Apple, which is the number one symbol that people have requested here for today. Now, the one thing I want to point us to is that Apple so far has held this 200-day moving average. This is a stock that I've talked about on CNBC 2 weeks ago as an opportunity, because as you can see here, it's held this rising support level fairly well, which coincided that 200-day moving average held that level. It is still below the 21-day moving average. I would like to see this break back above the 21-day moving average to resume a bullish trend. Otherwise, it's just kind of more in this triangle that it's forming here. Whoops. It's more in this triangle that it's been forming here, and then you need a resolution of this triangle and see if it breaks out one way or another to get that directional view. But from my perspective, when you look at these tech names like Apple, this is a highly profitable, revenue growth is still there, and they are likely going to continue to take market share away from other hardware players in this particular space. So for those reasons, trading at about 26 times next year's earnings, I think from a valuation perspective, this is a stock that I personally own, and it's a stock that I think is I've sold some puts here on Apple. This is one that I think is worth taking a look at from a technology perspective, especially if we're looking at high beta stocks. This is not in that same category as those high beta stocks. It's highly profitable and it does have revenue growth, unlike some of the other high beta stocks that may have the revenue growth but is not profitable. We're talking about the largest technology company here in the world. So for those reasons, I like Apple. Now, when we look at stocks like NVIDIA, this is a bit challenging, right? Because we played the breakout here on NVIDIA. That failed that breakout here. When it managed to break out above its all-time high, it quickly failed. It did hold the 200-day moving average, and so far has not managed to get back above the 21-day moving average. So again, similar to Apple, you really want to see a break above the 21-day moving average, in my opinion, to get into a long position here for NVIDIA. Otherwise, you're still in this neutral territory here. And today looks like we're about to open up just shy of this, let's just call it the 510 support level, which has been a major support level here for this particular stock over the past few months. And you have this rising 200-day moving average as support here. So you're kind of trading in this very tight range here. A break below the 200-day moving average, that certainly would be concerning here. As you can see on the weekly chart, there is a big move here to the upside since that $300 breakout. It's consolidated for quite a period of time. And the question is whether this is a topping formation and we're going to come back lower, or this is simply a consolidation range and you're going to continue moving higher here. We're going to come back and talk a little bit about some of the semiconductors after we take a look at some of the other stocks. But largely, if you look at the fundamentals of this company, it's fairly strong. It is very strong, rather. As you can see, on $16 billion in revenue, they've made $4.3 billion in income. So not in the same category as many of the high beta tech stocks that are not profitable, 25% margins, and also the most dominant player in this particular space. So from my perspective, this looks more like a consolidation range after what was a very big, strong move here to the upside. And this could consolidate for a little longer before it sees that breakout here to the upside, especially in the more challenging environment of rising interest rates. Semiconductor stocks have been one of the most widely hit across the spectrum with rising interest rates. But the fundamentals on these types of stocks, in my opinion, still look very strong. When we look at Tesla, this is another stock that has taken a huge hit off of the rising interest rates. And what's interesting about Tesla is this managed to get back to that 21-day moving average. It hasn't managed to close back above that 21-day moving average. It's stalled at that level here. Again, a break above that 21-day moving average would certainly target that $900 upside again to the upside. But so far, it has not held that level, and you could potentially see this stock maybe revisit that 200-day moving average, or at least revisit this 550 level here to the downside, which has been the support level on that recent sell-off, especially as rates continue to rise. If we see an acceleration in rates again above that 160 basis points, this is really where I could see some of these types of names come down. And remember, Tesla is a little different from most of the other names because Tesla does not really make a profit on the revenue growth that they've seen so far. They turn a very small profit on $10 billion in revenue per quarter. So Tesla is just kind of on the teeter, if you will, between these two segments. You have fast growth technology companies that are profitable and fast growth technology companies that are not profitable. Tesla kind of sits in the middle. And that's why, the chart kind of reflects that as well. It's managed to get back up to its 21-day moving average, while most of these unprofitable tech names have not managed to get back to that level. So the next couple of days, I think, is going to be really telling in terms of how markets react. If they manage to break above these levels, then you can take a look at some long opportunities. Otherwise, for now, I'm still in the more neutral state until we get that continuation higher. The next stock, people, we're looking at is GE. This is a very interesting one because this is a stock that I've continued to like. Fundamentally speaking, if you look at the long-term chart, you have this massive bottoming formation. And just actually, let me zoom out a little. This is a stock that was a $30 stock that went all the way down to $6 and put in this massive bottoming formation here over the past roughly year or so, and has now had one failed breakout here, but is now breaking out, in my opinion, a true breakout. Broke out above the 200-week moving average, is now coming back to retest this level as support. So this is the breakout level, just as zoomed in here on the daily chart. You had multiple attempts to break out above $12, broke out above it, came all the way back to test this level as support. So I think from a risk to reward perspective, you have a very attractive entry, not only on the daily chart, but also on the weekly chart, because as you can see here, you're now above the 200-week moving average. You have a lot of upside here, in my opinion. And the recent deal that they have with AirCap allowed them to take off about $6 billion worth of debt off of their books. They did have to write off about $3 billion or so, but this is cleaning up their cap table. This is cleaning up this business, making it smaller, making it more efficient. And I think from my perspective, the fact that it got back below these levels, below that $13 level, that is an opportunity to look for an attractive long exposure here, because your risks are fairly low. When you get down here to about $11 or so, if it gets down there, you can start cutting your losses maybe down to $10, but the upside up to 14, 15. And if you're a long-term investor, I think you could really shoot for the low 20s or so, at least $20 here to the upside for GE. So very, very timely trade, in my opinion, for GE. The next one is Riot. Now, Riot blockchain is really just a proxy, if you will, for Bitcoin. So I think the best thing to do is just take a look at Bitcoin. And the one thing I want to point out here is that we're starting to see massive negative divergence here from Bitcoin as it continues to make higher highs. It is failing to make higher highs on momentum. And as you can see, money flow is looking weaker and weaker here on Bitcoin. So we have this double top here forming around $58,000. From my perspective, this looks like this has at least some legs to get back down to the 45, maybe as pull back to as low as the $42,000 range here for Bitcoin. This looks like a bit of a topping formation that's starting to put in here, unless you get a breakout here above this level with some true volume here. But as you can see on subsequent rallies, also volume has been declining. This is concerning for how Bitcoin is setting up here. These moves have just been becoming more and more exhausted here to the upside. A lot of divergence here across the board. So when you look at that, and you look at Riot Bitcoin, you know, the chart really is not too different. And you can see it on the weekly chart here as well. As you can see, massive negative divergence, declining money flow, declining volume here on all subsequent moves. This is, in my opinion, what you typically see near a market top, and that's what we're likely going to see out of Riot as well. You move here to the upside. Now, Riot hasn't made a new high yet, but I think this is part of just a stock like this reaching a bit of an exhaustion here. So that's my view on Riot. Next one is Boeing. A lot of investors asking about Boeing, and Boeing, you know, interestingly enough, so far breaking above this 237, 235 level, which was that June high. It was that November high, breaking out here. And if we look at Boeing, you know, the breakout certainly is constructive, right? Because you have a long-term, I would say, bottoming formation that has been put in place here. Let's just call this a bottoming triangle, if you want to call it. You have the first real breakout above this level, and that would target, in my opinion, up to this 285, 287 level here to the upside. And if, you know, the order book doesn't look particularly strong here for Boeing, but I think most of this is based on the inflection that we're starting to see on North American commercial flights. We've seen that pick up here in flights over the past few weeks. That's what's driving, in my opinion, this stock price. And most of that, you know, recovery in terms of commercial aviation here, not only in North America, but also Asia and Europe, has been driven by narrow bodies. And that's where 90% of Boeing's order book is from, is from the 737 MAX, which has returned back to service. For the most part, it seems like travelers are willing to take flights on that plane. So for those reasons, I think there's a little bit of vote of confidence here for Boeing. And as aviation starts to pick up a little, we're seeing that reflected in the stock price. So for those reasons, you know, if you're a long-term investor, I do think that this is potentially an entry point for Boeing, but I don't know that you have a lot of upside. I think you're looking at about 285, 290 to the upside 330 would be the long-term target here, but I think you're far ways from getting back to 330 because the order book of Boeing has declined by a significant amount since Boeing was trading at 330, where the 737 and the wide body order book was substantially larger at that point. So for those reasons, I think the upside is limited here for Boeing. Next trade here is Microsoft. Now we've covered Microsoft here on CNBC last week because you have a strong, technical thesis. You have this 225 level that has held as support. We're really playing defense here with Microsoft. So like I said, we have on one end of the spectrum, these tech names like Apple and Microsoft, and even some names like PayPal, where you have effectively what is the dominant market player in their particular space. They're highly profitable, high margin business, and they continue to grow their business at a fast pace. Microsoft, Apple fall into this category. So even as interest rates rise, these are not the stocks that are going to get squeezed. They have a little bit of a pullback here, but these are stocks that are not trading at ridiculous valuations. Microsoft currently at about 32 times next year's earnings, similar to Apple at about 26 times, which is why I like Apple a little bit more. It's a little cheaper than Microsoft, but Microsoft does have a higher margin, more sustainable SaaS business versus Apple is more of a one-time transactions business with their hardware business. That's why Apple trades at a lower multiple. But largely, these are the types of tech names that you want to find a bit of safety in if you want to remain invested in tech, but you're concerned about, the rise in rates and what that's going to do for the non-profitable tech names. So Microsoft, certainly one that is on my radar for as a technology player. The next request here is for NEO. NEO holding up fairly well here for a high beta technology stock. As you can see, this is the $40 level that it's been holding for quite some time since the November election. This has been the support level for this stock. It has really failed to make any real highs since the election. So far, holding this level, a 21-day moving average is also critical here. It seems like NEO is, at least for the Chinese electric car companies, holding up far better than XPeng and LI. So far, they have about a 400% year-over-year growth in deliveries in terms of car deliveries, which is in line with exactly what XPeng and LI is showing. And actually, LI and XPeng, because they're smaller, actually has a slightly higher year-over-year delivery, which is really strong about the fact that NEO, a significantly larger company, still growing at the same pace as their smaller rivals. But just keep in mind, they're only delivering 21,000 cars per quarter. So we're still talking about a small number of cars in terms of delivery, but the delivery data has been strong. The battery demand for NEO, which is their main, I would say, differentiator, the battery swapping technology, there's been strong demand for that. And for those reasons, that's why this stock is continuing to be the stronger player of all of the Chinese electric car companies. But as you can see here, this has made no progress. It's actually, back to where it was trading back in November. So you want to see more progress on stocks like this. You want to see a break above that 21-day moving average. You want to see it get back above $60 or so and break out higher here. Otherwise, you're still in this kind of neutral zone that we've been in since the election. It's failed to break out above this level multiple times, each time failing to break higher here. But it does seem to have, collecting a little bit of legs here, as it held the 200-day moving average. Also, that consolidation range that we're talking about after a big move here to the upside, it could consolidate for a little bit longer, especially as interest rates continue to rise before you get that breakout. But I would wait for that breakout here, in my opinion, as a long-term investor for NEO. Next, we want to take a look at is AMD. AMD sits in the exact same time framework as NVIDIA. And these two tech semiconductor stocks have actually largely underperformed their sector. So if we look at AMD versus SMH or NVIDIA versus SMH, these are stocks that have, over the past roughly 6 months or so, largely underperformed their index. But these are also two of the largest players in this particular space, especially in the CPU and GPU space. And AMD continues to take market share out of Intel here. And AMD is talking about 5 nanometer chips in 2020. Intel is still trying to catch up with their 7 nanometer chips in 2020. So for those reasons, when you put the AMD versus Intel next to each other, Intel certainly still has the performance advantage here. There's no doubt about that. But there are strong cases, in my opinion, for a fundamental reason for why AMD will continue to take market share away from Intel, as they have some stumbles on their execution of the 7 and 7 nanometer chips, which AMD is already out there with, and AMD is already looking at 5 nanometer chips with Taiwan Semiconductors in 2020. So for those reasons, this is a stock that has so far held the support level, but is still in that consolidation range. Until it breaks out above that consolidation range, it simply underperforms the sector. In my opinion, you're better off just buying SMH or buying one of the ETFs for the sector, because you're largely going to outperform some of these big cap names until you get a breakout, until you can see AMD start to outperform the sector. This is not necessarily where I think you have the best opportunities within the semiconductor space. And I'll talk a little bit about that when we get down to Qualcomm. So the next one is ARC. This is a lot of interest here in ARC, because obviously this is one of the best performing ETFs in the markets, and they are well known. They have a lot of assets under management. And just to put this into perspective here, let's take a look at how big of a pullback here, because as big of a pullback we've had, it's still been relatively small. We just got back to the 382 fib level here. We've now retraced back to the 236 fib level. And the question is really whether or not this has another leg down here or not. And this really comes down to the rising interest rates. So if we continue to see interest rates rise, I think that there's a fair chance that ARC will revisit this 106 low here and kind of range bound a little bit before it can continue to break out higher here. We've seen this a lot in terms of the NASDAQ 100 index doing that after having a strong move here to the upside and needing to consolidate for a bit of time before it can continue. So that's really where I currently see ARC. However, there are some strong names within ARC that like I said, are just within spitting distance of getting back above their 21-day moving average. Because if you get a breakout above the 21-day moving average, in my opinion, that puts you back towards that 160 level here. But we're not there yet. We may just be a couple of sessions away, but we're not there yet on these names. But you have similar setups in PayPal, you have similar setups in Tesla, in CRISPR. Many of the holdings here in ARC have the exact same setup, just on the verge of breaking above that 21-day moving average, but not quite there. And pre-market, as you can see, down about almost 3% here on the rising interest rate. So that's my concern, that you just get one more leg down to that 105 level, consolidate for a bit of time before it can continue moving higher. Next one is Alibaba. This is one that has really fallen from grace here. As you can see here, let's just call it the 280 level, or 270 level here has been what has been resistance, support for quite a bit of time, but has now formed resistance here. So this is a stock that is continuing to lose ground to their smaller rival JD. This really talks to the regulatory issues that we see with very, very large cap tech names in China. This morning, Tencent getting hit again about 5% on anti-monopoly concerns from the Chinese government. So for those reasons, Alibaba, Tencent, I don't think are going to perform very well here in this type of market environment. So this is one that I do think I would stay away from. And even those that are invested in JD, you may be concerned about whether or not there may be regulatory issues coming down the line for some of these large technology shares in China. Next one is DraftKings. This is one that continues to outperform and execute very well, breaking above the $65 resistance level, having one failed attempt about last week, making a new attempt here. It hasn't broken above this all-time high around 72, but certainly the stock is setting up for a fairly strong move here to the upside. The thing about DraftKings is the fact that it continues to increase market share. It's definitely executing very well on gaining market share against their rivals here, really, which is Penn Gaming and MGM. But DraftKings seems to continuously do better at increasing their margins, increasing their market share, and their margins are fantastic. 58% operating margin here. So when you have these types of names like DraftKings, where the operating costs to these firms are relatively low, they spend all of their money on gaining market share, and they're potentially turning profitable in 2023, 2024, and with very high operating margins. That's really why I think this stock is performing well. There's a lot of optimism around their launch in Canada. So for those reasons, this is why this is a stock that continues to do well. This is highly speculative, in my opinion. There's a lot of regulatory, risk, if you will, here with these types of gaming online betting sites. So that's the risk that you take, but so far investors are being rewarded for that risk. The next one I want to take a look at is Netflix. Netflix has just been in this kind of range-bound rut for 6-7 months or so. And the one thing about this is that, I think you need to remember that as a constituent of XLC, the communications, Netflix has largely performed on par with the communications sector until the last couple of weeks, where it really started to fall apart, meaning it's falling behind the sector. Meaning if you hold XLC or if you hold Netflix, you're starting to see some underperformance here. And this is a pretty large topping formation here since the beginning of the pandemic, right? You've had the outperformance into the pandemic. You've had this kind of almost like what looks like a head and shoulders formation, almost like two right shoulders, and really starting to fall apart here. And this, from my perspective, targets here to the downside. Now, this is a relative chart to its sector, but this is a chart, as you can see, has held that support level fairly strong throughout the entire pandemic. But over the past few weeks, started to fall apart here. So that's not particularly attractive for this particular name, even though on an absolute basis so far, it's still climbing higher here, but on an absolute basis, on a relative basis, losing ground here. So for those reasons, I think that this is a stock that could potentially have some downside from a technical perspective. And also, if you look at the business, there's really not a lot of innovation coming out of Netflix. It is one of those providers that just everyone has, but subscription growth has continued to slow down. When we look at what type of new features they're launching, it has nothing to do with innovation. It's really, how can they prevent people from sharing passwords? When businesses are relying on things like that and price increases to keep up growth, that is, from a fundamental perspective, not particularly attractive, unlike some of the other streaming providers that are really trying to innovate on the content side. So for those reasons, I think Netflix is at risk here to the downside. PayPal, PayPal is similar to some of the other names that we have seen from the perspective of, especially out of ARK. You've seen a big move to the downside here. And just to put things into perspective here, you have this 225 level that has managed to hold here. So this was the level that we've had here since December. I would like to see this break out above that the 21-day moving average to potentially get back up to that 310 level here. PayPal, like the other names, like I said, is profitable, right? It's a high growth tech name in terms of the payment space, which is largely a strong space to be in, especially with the growth in e-commerce. And PayPal having 99% of their exposure to e-commerce is fairly constructive from that perspective, and it's profitable, unlike some of its competitors. So for those reasons, it is one of those tech names that I do think is worth paying attention to and looking at, especially if it breaks back above that 21-day moving average. So far, today is not that day. Today is not the day where we're seeing these names get back above that 21-day moving average. Most of these names are actually getting rejected at that level. So I think I'd be a little bit more patient, wait to see if by Monday things calm down a little with the rates market and we start to see a little bit of investors tiptoeing back into some of these tech names. If that's the case, that is the opportunity here to the upside. Zoom is interesting. This is one that we have a short position in, and the reason that we have a short position in is because of this chart. Similar to that Netflix chart that I was showing you, Zoom, as you can see here, this is relative to the communications sector. This is the pandemic breakout here, the big breakout, and as you can see, after multiple months of failing to make new highs, we're making lower highs, and we finally broke below that resistance level. And this is zoomed out here on this particular chart. On the daily chart, we have a breakout here relative to the communication sector, continued underperformance to the sector since October, and we finally got the breakdown to the downside. They're coming back to retest this level as resistance and potentially underperforming the communication sector. And if we look at the absolute chart here on Zoom, breaking below the 200-day moving average, coming back to retest this level as resistance and potentially failing to go back down. So this is really what we're looking at here for Zoom. We're looking for a potential breakdown here for Zoom before it actually breaks down on the absolute chart. It's already broken down on the relative chart. That leads us to potentially believe that there is further weakness here for Zoom. And really, from my perspective, I love this company. I think they're very innovative. But the thing is that revenue growth has slowed down substantially. We've only seen 13% quarter-over-quarter revenue growth here in a name that was seeing 100% revenue growth down to 20%, down to 13% revenue growth. Next quarter could be flat or potentially even down. That is the risk that I see here for Zoom and why I think there could be some downside for a name like Zoom. Next is Amazon. Amazon, very similar to that. This is Amazon's absolute chart, right? As you can see, really just moving sideways here over the past 6 months or so. But when we look at Amazon relative to its sector, consumer discretionary, now this is a stock that has led the consumer discretionary for years, starting to see some cracks here, starting to underperform the sector over the past 6 or 7 months, starting to break below some support levels here. So Amazon has not broken the support level just yet, but as you can see, it's on the verge. It could potentially break out here. Not to say that Amazon can't come back here, but that absolute chart, or I'm sorry, the relative chart underperforming the sector is concerning to me, especially when you see stocks like Target outperforming its sector. Target outperforming XLY, consumer discretionary, over the same 6 months. This is really where we see a bit of a shift here. Amazon and Walmart, number 1 and number 2, dominant players in this particular space. But the smaller player Target is starting to play catch up. Target is actually increasing their market share faster than Amazon and Walmart right now. So for those reasons, I think if you're looking at consumer discretionary, you're looking at e-commerce, I think there are more interesting names, especially, and you have to mix in the fact that Amazon still has the web services business, but, the stock performance just does not reflect the upside of web services, especially since Microsoft is now taking market share away from Amazon on the web services side. So Amazon is being attacked on both sides, by Target on the e-commerce side, by Microsoft on the Azure side, and investors are clearly sending a signal that things are not looking as strong here for Amazon. Next is CCIV, Churchill Capital. Now this is purely speculation because this is an SPAC that bought Lucid Motors. You had an SPAC that was trading at $10, got all the way up to 64, got clobbered all the way down to about 20 bucks. It looks like it's starting to climb its way back up here. This is purely just speculation. This is nothing. There's no real fundamentals to go off of. There's no real technicals to go off of. This is pure speculation of a potential electric vehicle car company that, still to this day commands some pretty rich valuations for a company that effectively generates no revenue whatsoever, trading at about $7 billion in market cap. So, this really, maybe if I were you, if you're interested in investing in this type of company, do a little bit more research on Lucid Motors, see what your thoughts are in terms of the financials, whether they really have the legs to survive. This is a company that has come back from resurrection a couple of times already. Maybe this is the time that they managed to do it because they've been able to raise money from the public markets. So, I'm not here to speculate as to the long-term viability of that car company, but if you want to do that research and you want to decide, this is the vehicle for you to go about expressing that view, the CCIV, Churchill Capital. Next is Plug Power. Plug Power is interesting from the perspective of Plug Power continues to rise, their revenue growth continues to be fairly strong here, as you can see, going from 40 million to 68 million to 106 million in just the last few quarters. So this is one where, we don't have, it's certainly not profitable, but you certainly have the revenue growth, very strong revenue growth quarter over quarter to support this rich valuation that we're currently trading at, which is roughly quite a bit, almost 100 times sales. Based on the last, a little less than that, probably closer to 60 to 70 times sales, but still very rich valuation. But as you can see, just shy of breaking above that 21-day moving average. Looks like this is one of the stocks that are getting hit pre-market because of that rising interest rate. So for those reasons, I do think that you could see a little bit more downside here, but the levels that I would pay attention to here is this this $38 level, which held on the last move here to the downside. If it holds that level and breaks back above the 21-day moving average, that would be constructive, in my opinion, back up to that $73 move here to the upside. Qualcomm. So this is another one similar to NVIDIA, similar to AMD. Qualcomm versus its sector, SMH, is continuing to underperform. As you can see, big underperformer of its sector, especially in the past few weeks. But it is managed to get back to a major long-term support level here. So for those reasons, I do think it's potentially worth taking a look at some of these names, because Qualcomm does, unlike some of the other semiconductor names, turn a nice profit, and it has pretty decent margins here, 35-29% operating margins. So for those reasons, especially the fact that it got back down to the 200-day moving average, this could potentially be an opportunity. But you do have some resistance level here around 136, 142. This is one that's going to be perhaps a bit of a struggle to get through these resistance levels. If it can get back above 142, then you can see a 170 or so. Long term, the chip space, it's at least for me, I think the more what's the right word? Impressive opportunities, in my opinion, are in more of the semi-cap names like Applied Materials. As you can see, continues to outperform. It's managed to get back above that 21-day moving average. Lam Research, LRCX, hasn't quite gotten back to that 21-day moving average, but as you can see, continues to make higher highs. That's important for for a particular name, is to continue to make higher highs, especially as it kind of consolidates a little bit. That leads us to believe that it's more likely to break out here to the upside. You have NXPI on the auto side breaking above its 21-day moving average here, looking substantially stronger here. Texas Instruments also breaking above that 21-day moving average. These are the types of tech names that I think are more attractive at the moment than some of the NVIDIA, AMD, and Qualcomm, some of the larger, more established players that have largely underperformed the sector. Now, I do think that if we look out a little bit longer, like into the 3 to 5 year space, most of those big tech names, the big semiconductor space, have quite a bit of upside, but right now they are underperforming. Same thing with TSM. TSM, Taiwan Semiconductors, looking a little weak here, failing to break out to that new high, and is now well below that 21-day moving average. This is one that's looking a little weak here. Having to break back above that 120 level here. I do think Taiwan Semiconductors is one that has potentially some downside, maybe to this 107 area, and potentially as low as to 102 area. Those are the pullback levels that I'm currently targeting here to the downside for Taiwan Semiconductors, as they are looking a little bit weak here, especially as the stock is kind of priced for perfection here, and the 7 and 5 nanometer chips, we're talking about shortages in some of those chips. That's going to put some pressure here on TSM, in my opinion. Unity Software. This is one that has really fallen from grace here over the past few weeks. And the one thing I will point you to, the reason for it is because it's a rich valuation stock, and it's had zero revenue growth here over the last 3 quarters. This is a stock, it's a gaming stock. This is a stock that should be doing very well in this particular environment, but revenue growth is not there. It continues to lose money. Those are the types of stocks that are going to get hit. You have a bit of a bounce here over the past few days, but I think this is a stock that's more likely to see a little bit more downside. Apps, Digital Turbine. This is one, if you look at it, you have this $95 double top here. You do have strong relative strength here, just generally speaking, outperforming the broader markets, outperforming its sector. But you do have this double top here. I would like to see a breakout above that double top for it to continue. And what's interesting about this particular trade is that it is expensive at about 20 times sales, but it does have strong revenue growth. Revenue growth continues to be strong. It is profitable too. So that is one of the reasons why, unlike some of the other names in this particular space where, it's high growth, but they're losing a lot of money, this company makes money. So for those reasons, this is one that I think if you're going to be on the more speculative tech side, this is one that I would be looking at a little bit harder. Charge point. This is, charging stations, if you will, for electric vehicles. And we're a big fan of electric vehicles, but the stock isn't particularly strong here. You've had a big sell-off here to the downside. Checkpoint, the thing about this company is that, I've been reading a lot more about the economics of these charging stations. And the reality is that these charging stations are extremely expensive. And for them to really get any scale, they need to grow substantially larger than where they are today in order to get the scale. And the economics of these aren't particularly strong. The stock's down 14% pre-market here today. These are not the types of companies that I think I want to look at, because they have no path to profitability in the next 3 to 5 years, and it's extremely expensive to compete in this particular space. So for those reasons, it's highly speculative, and the chart doesn't look particularly great. The financials don't look particularly great. So this is not one that I personally would touch. We have Costco. Costco has really fallen from grace here as well. Costco versus the XLY sector, as you can see, has really fallen apart here. We're really talking about multi-year lows that we're starting to hit here on Costco. It is coming across some long-term support here on a relative basis, but Costco, as you can see, very, very weak here over the past few months relative to its sector. So Costco losing ground not only on an absolute basis, but also on a relative basis. And it's getting back up to this 330 level here, which, as you can see, is a major support and resistance level, but is now acting as resistance. So I'm concerned that you're going to see a little bit more downside here from Costco. And keep in mind, this performance we're seeing from the stock is on the backdrop of fairly strong earnings. This recent earnings report was not weak at all, but investors are not impressed. Investors are not buying into it and seeing some further downside or further erosion, if you will, for 2021 profits here for Costco. So for those reasons, technically not particularly strong, and fundamentally, while solid, the growth there for the second half of the year does not seem to be there. So for those reasons, Costco doesn't look as attractive. Salesforce. Salesforce also looking a little weak here. Broke below the 200-day moving average, which has held for quite some time, but is now broken below those levels. You have this pre-gap level at around 218. So, I think I had shorted Salesforce somewhere in this area, targeting here to the downside. It took quite a bit of time to get down there, but then this level held for quite some time here, this 218 level. But recently broke below that level, and we're just back at that level as resistance. So this is risk, a bit of a risk here to the downside. And remember, Salesforce, part of the technology sector. So when we look at Salesforce relative to its sector, notice the large underperformance of the sector, and recently breaking down below it and looking for potential downside here for Salesforce. So for those reasons, you look at that, and again, Salesforce, similar to Costco, decent earnings, right? The earnings wasn't weak at all. It was roughly in line with what markets were expecting, but it seems like when earnings come out as expected, that's really turning into a bit of a negative here. Really, stocks need to outperform what is expected just to keep pace with the broader market. So we're seeing stocks that are basically coming with earnings that are solid, that are on par with what markets are expecting. Those are the stocks that are being sold off here. DocuSign. So far, DocuSign has held this 190 level here to the upside, but I will say DocuSign, which is a high growth technology stock, the one thing we want to pay attention to is the fact that this is not a profitable company. It has managed to continue to grow its revenues a little bit here over the past few quarters. It actually has, decent revenue growth, I would say, but on the back of that, it continues to lose a fairly substantial amount of capital on the back of that. So the fact that it has held the 190 support level, it's held the 200-day moving average, is constructive, but If you look at DocuSign relative to the technology sector, as you can see, starting to show some cracks here. Largely been on par with the broader sector, keeping pace with the broader sector, pulling back here now, coming back to retest this as resistance, potential downside here for DocuSign. So a lot of these tech names, you're starting to see these cracks show, especially in the ones that are not profitable. Those are the ones where the cracks are starting to show relative to its sector. Those are the ones that, if you're looking for short opportunities, those are the ones I would focus on. Ford, interestingly enough, as Tesla continues to see some substantial downside, GM and Ford new relative highs. Both GM, just about to break out above this triple top here around 57. Trading near all-time highs. Ford, same thing, breaking out to new all-time highs. Ford actually outperforming GM here. Now, this, from my perspective, is really due to the fact that Ford has more debt on their books than GM, far more debt than GM, breaking out above that 10.5 level. It hasn't really looked back, so I think that we're likely very easily going to hit this 1350 level here to the upside. That was the last resistance level we see here on the weekly chart, but it's broken down below the 200 week moving average for a long period of time, and finally broke out above that level and has some legs, in my opinion, up to that 13.5 and potentially back into the 17, 18 level long term here for Ford. And lastly, fuel cell energy. Now, this is a stock that has managed to get back. First of all, has held this $11.5, let's just call it support or resistance level. It broke back above that 21-day moving average, but pre-market getting hit again, down 7%. So this is a stock that may more likely look more neutral rather than bullish here. What looked like it was going to be a continuation higher here from yesterday, so far looking like it's getting rejected at that 21-day moving average. Now, the thing about hydrogen, is that clean hydrogen, which is different than just hydrogen power, it's far from being commercially viable. And this is a company that continues to see revenue compression here. So for those reasons, I'm concerned it loses more and more money on that revenue that it gains here. So fuel cell is certainly a leader in the hydrogen fuel cell space, but commercial viability of what we would consider clean hydrogen is far from there. And if you look at the long-term chart here, this big move we've seen to the upside, while impressive, as you can see in the large scale of where the stock is barely a blip on the radar here. So I am concerned that looking at the revenue declines over the past few quarters, continuing to lose money, this is one that I'm concerned that you're likely to see a little bit more of a pullback here on a name like fuel cell, which is quite speculative and isn't exactly growing at the pace that you would expect to see on a stock that's going from $2 to $30 in a short span of a few months. So with that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to where we currently sit in the broader markets and answer a lot of questions regarding just the technology shares, which is really what our focus, or many investors' focuses are on these days, and making sure that you understand how to segment between these high beta tech stocks that are not profitable versus high beta tech stocks that are quite profitable, and kind of seeing that divergence between the two. We threw in some communication names, we threw in some discretionary names, giving you a sense for that, as well as some of the semiconductor names, because there is a pretty wide spectrum here, and there are opportunities still to the long side, but there are also, in my opinion, quite a few cracks that are starting to show to the downside. So with that, what we'll do is we'll send you a link to the recording. We'll send you a link to the slides so that you can follow this along at your own pace. And I hope that you guys find this useful in giving you a better understanding as to opportunities in the short run. Thank you so much. I hope you guys have a great trading day, and I'll see you guys here on CNBC later tonight at 5:30 p.m. Have a great trading day.